The most important shot in golf is the next one. Ben Hogan. Welcome back to the Mortgage Caddy Podcast. I'm William Ware, your caddy through home loans, business lending, and everything in between. Last episode, we introduced the clubhouse and shared the game plan. Today, we're zeroing in on some common myths that are costing buyers real money. So grab your driver and let's step up to the tee. So, you've probably heard a lot of statements like, you need 20% down to buy a house, or the lowest rate always wins, or you can't buy a house if you have student loans. These may sound harmless, but each one can sneak up on you and shave off your financial birdie. Today, I'm going to break down 3 of the biggest mortgage myths, explain what they really mean in 2025, and how you can avoid getting trapped in the rough. So myth number 1 is that you need 20% down to buy a home. This myth has been around long enough that it feels like gospel. But the reality is, many programs today require way less than 20% down. Sure, a 20% down payment's nice, it leads to fewer hurdles and less mortgage insurance, but it's not always a requirement. Currently on the market today, there's conventional loans that offer 3 to 5% down for qualified borrowers, FHA loans that offer as low as 3.5% down if you qualify, and VA loans that offer 0 down for eligible veterans and service members. So, let's say you find a home in Florida or Colorado and you put 5% down to get pre-approved. You move in a lot quicker than the guy who's still waiting to save up that 20%. Waiting for the 20% down is like standing on the tee waiting for the perfect wind and smooth green. Meanwhile, the game's moving on. Instead, pick the club that fits your swing now, and you'll be ahead of many waiting for the perfect shot. If you're a buyer, meet with 3 lenders this week and ask them specifically, what's the minimum down payment I qualify for in my market and my loan type? And if you're a realtor, you should be encouraging your clients to explore low down payment programs early on. You'll not only keep your pipeline moving, but you'll be avoiding the long wait in the end. Myth number 2 is that the lowest rate is always the best deal. Sure, everybody loves hearing lowest rate, but if you chase rate alone without considering the full picture, you may end up with a worse deal. The interest rate is only part of the cost of buying a home. You also have to factor in closing costs, discount points, the loan term, your private mortgage insurance, and how long you plan on staying in the home. Suppose you take a loan at a slightly lower rate, but you pay thousands of dollars in upfront points. If you sell or refinance in 3 to 5 years, there's the possibility that you'll never recoup those costs, and somebody who took a slightly higher rate with fewer fees ended up better off. Picking a driver just because it's the lowest loft may sound good on paper, but if it doesn't match your swing speed and the roll on the fairway, you're going to end up in the rough. Same thing with the rate. Match the loan terms to your time frame and financial swing, not the lowest out there. Buyers, when you're comparing loan offers, ask for the APR, or the annual percentage rate, and ask, how long do you expect me to be in the home? Realtors, get your clients educated. That it's not just about the rate. It's the full cost and term. And myth number 3 is that you can't buy a home if you have debt or student loans. Look, debt fear is a real thing. Student loans, credit card balances, auto loans, they all count in the equation, but this myth oversimplifies the situation. What lenders look for is your overall debt-to-income ratio, or DTI. They also look at your credit history, your savings, and your overall stability. Not just any debt equals no home. So for student loans, depending on whether the payments are deferred or income-based, some are counted differently. Revolving debt with high balances near the limits will hurt your credit and in turn hurt your DTI. But you can absolutely start prepping now. Start by reducing your credit card balances, avoid adding new large debts, and keep your credit profile stable. It's like saying you can't ever play an uphill hole just because you carry a 5-iron instead of a driver. Sure, you have to adjust your shot, but you can make par if you pick the right club and approach. Buyers, make sure to ask your lender what your DTI is, what counts in that DTI, and how you can improve your DTI in the next 60 to 90 days. And realtors, help your clients see the path forward. Debt is not always a deal killer, but unprepared debt can be. Alright, now for the course conditions. Here's what's happening in November 2025, the Florida and Colorado market snapshots. And an update on a new drive changing the game, the 50-year mortgage proposal. So the average 30-year fixed mortgage rate is holding in the mid 6% range. Rates are not plunging yet, so being prepared rather than waiting is the smart play. In Florida, inventory remains tight in many coastal and suburban markets, so buyers who are ready, with a pre-approval in hand and a plan, they have the advantage. In Colorado, some markets are showing more balance, with moderate price growth and more negotiation room, but action is still required. Now, you may have been seeing the headlines recently about the 50-year mortgage. So here's the scoop. The Federal Housing Finance Agency, or FHFA, and federal officials are discussing backing mortgages with a 50-year term as a potential affordability home. On a $415,000 home with typical terms, switching from a 30 to a 50-year mortgage could drop your monthly payment a bit, roughly around $200, but it would increase the total interest paid by hundreds of thousands of dollars and delay your building of equity. Critics are warning that while the payments lower, equity accrual slows dramatically, so someone might still be paying off their house well into their 80s or 90s. For you as a borrower or a real estate professional, it could offer a way to fit monthly costs under budget. But it's not a silver bullet. Housing supply, rates, and personal strategy still matter more. Ask yourself, am I okay with building equity slowly? What's my horizon? What's my planned retirement age? And how long do I plan on actually keeping the home? Tip for this week, if you're shopping alone, ask your lender. If a longer term option like 50 years becomes available, how would it compare to a 30-year for my specific scenario? What are the trade-offs for me long term? As a realtor, help your clients understand what these proposals could mean and where they might work and where they might hurt. So let's keep this short. When you're evaluating mortgage offers, do not fixate only on the interest rate. Focus on the APR and the full cost of ownership. Why? Well, rate is just an interest percentage of the loan, whereas the APR is the rate plus most of the fees plus the cost of borrowing over time. A slightly higher rate with lower fees might beat a lower rate with high points if you plan to move or refinance soon. Picking the loan with the lowest rate is like choosing the driver with the longest member listed distance. But if you can't control it, you're still going to slice. You want the club or loan that fits your swing or financial plan and gives you a reliable result. Buyers, you need to get loan estimates from at least 2 lenders and compare the APRs side to side. Realtors, ask your preferred lender to walk you and your client through an apples to apples APR comparison, as it builds trust and shows its strategy. So, let's recap. We went over myth number 1 that you don't always need 20% down to buy a home. Myth number 2, that the lowest rate isn't always the best deal. And myth number 3, that having debt does not automatically disqualify you, but you do need a plan. For the rates staying in the mid 6s, and Florida and Colorado each have their own unique dynamics, and the 50-year mortgage proposal could change the game, but with big trade-offs. And lastly, focus on APR, not just interest rates. In the next episode, we're going to dig into shopping lenders like a pro, how to read between the lines. We'll walk through questions to ask, lender red flags, and what the best lenders do differently. If you found value today, subscribe to the Mortgage Caddy Podcast. leave a review, and share this with a friend. Your realtor or business owner buddy could use a caddy too. You can also follow me on Instagram at the Florida Mortgage Caddy for quick tips and market updates. So, until next time, keep your drive straight, your credit strong, and your strategy tighter than your short game. This is the Mortgage Caddy Podcast. Thanks for tuning in, and I'll see you on the next hole.